Hey everybody, welcome to the Young Bucks Show, the death episode. That's right, today we talk about all the industries that are getting murdered by Amazon.com. We also talk about all the industries that the millennials are killing. So stay tuned for that. We also explain what a value trap is and how you can avoid it. And stay tuned to find out who our college football picks are for the week and to see if Ben can correctly pronounce Uber's new CEO's name. What's up, everybody? Welcome back to What the Buck, the segment in which we talk about all the things that matter in the world about money. Andrew Hall joining me today, Sam Frost over there, Ben Nye over there, Matt Krebsbach right here. Now more microphones than ever, so you're welcome, everybody. First things first, Ben and Krebs, a little bit of follow-up to a segment you did last week.
Nailed that one.
What was that segment called? Power Players or something like that? Loosely autobiographical. Talk to us about Uber's new CEO, and the real question here, Ben, can you pronounce the name?
Yeah, so Dara Khosrowshahi has joined from Expedia.com. Exactly. He was the CEO there since 2005. This came right on the heels of Jeff Immelt, who was a former and fired GE CEO, taking his name off from being under consideration. It's not a coincidence that someone else was hired like 6 hours later. I think that he knew he wasn't getting the job and didn't want another failure on his record. First, he leaves the Winning Jobs Council from Trump. Then he gets fired as GE CEO, and then he gets looked over for Uber. So I think it was a good appointment, though, by Uber. I think he brings a little more of a grown-up mentality to the management team. He has experience running a large organization in which he has to provide an internet service to many different people.
Personally, I'm surprised that he took the job, quite honestly. I mean, like you said, he's at Expedia since 2005. And not that I follow Expedia or like Priceline or those type of companies that closely, but as far as I'm concerned, they're doing pretty well. And like they're growing. Like, it seems like taking a job at Uber, that's like bleeding money. And I don't know what his compensation package was. I didn't see that either, but to take a job at Uber, where I think you take a lot of just a risk of like making yourself look bad or make yourself look great if you can turn it around. I don't know. But.
I mean, I don't think there's much to turn around. I think the company's still doing very well in terms of getting users, and that's what the market's paying for right now.
Yeah, if you look at it that way, yeah.
And I mean, if it's worth $60 billion pre-IPO, I mean, I think that you can make a case that.
Or if he's thinking, I'm going to IPO this and just cash in like no other.
I mean, he's already made it. So now he can really, really make it.
Mm-hmm. All right. So we'll see what happens. We'll continue to follow that developing story with our own power players, as they've called themselves. Next up, Hurricane Harvey. Obviously a big story this week. Lots going on there. Lots of flooding in Houston, certainly. So, you hate to be insensitive on something like that where there's lives at stake, but at the same time, this is an investing show. It's a show about money. It'd be somewhat ignorant of us not to realize that there's economic impacts to these type of things. So got a couple different sectors here or industries that could be impacted. Retail sales, auto sales, insurance companies, obviously something you start to think of when claims start trickling in, refineries and pipelines. Sam, I'm going to start with you. Which of these areas do you think is maybe the most at risk from the fallout of Hurricane Harvey?
I'm going to go a different direction and not say who's most at risk, but who has a really good opportunity. I think that would be someone like, I mean, this might be a cop-out answer or obvious answer, but like someone like Home Depot or Lowe's. Home Depot, we've talked about a little bit, they're just a machine. They just crank out results just quarter after quarter, and then all of a sudden they have this huge natural disaster that's going to require a ton of just maintenance, repairs, remodels, whatever. And so where do you go? You run down to Home Depot, you run down to Lowe's to get what you need. And so I think those are two companies to maybe watch, maybe get a little boost from this.
Yeah, and we saw, I know we work with one home builder pretty closely here locally, just a privately traded one, but they actually got a lot of work from FEMA in terms of rebuilding projects. So that'd be also be something to keep an eye on in terms of those government jobs. Mm-hmm. And they got to buy their supplies from somewhere. Right. So kind of makes sense there. Krebs, thoughts on some industries that may have an adverse impact and what the fallout may be from some of them?
I'm going to lump two together. I'm just going to go pipelines and refineries. I mean, when you're at Corpus Christi and Houston, like that's literally the spot in the United States where all that stuff's going down. Like all those splitters, like all the natural gas liquids, all that stuff that is going on right there. You've seen that impact on a lot of those stocks already. I guess they rebounded somewhat today, but like their next quarterly results are going to be impacted. Like they've had to shut down those facilities and pipelines, but I think there's no like major damage there.
When you see that,
you could look at it as like a buying opportunity.
Right. It seems like it's something to be priced in really quickly and immediately kind of digested by analysts, and should lessen the degree of surprise. Like you said, it's going to show up.
Yeah.
Matt, what do you
it's
think?
It's just a one-time thing.
What do you think this
Hopefully.
does anything for just the general macro in terms of oil? Because I would venture to say supply is going to decrease now that a huge oil market is kind of out of commission for a little bit. Is that enough to impact the world oil supply, that macroeconomic outlook?
Oil, I don't necessarily think so. I think it's more the refined products. Okay. Like, there's not much oil drilling going on where that is. It's just all the refineries are there. So there might be like a stockpile in oil, but you're going to see a decline in the stockpiles of refined products just because those are getting used up and you can't refine more.
Gotcha.
If that makes sense.
Yeah.
Yeah, Ben, thoughts on what's going to be impacted and some of the fallout?
Yeah, let me just hit those last three industries that you had. The first is retail sales. I think that retail sales will probably end up being a wash, and the reason for that is I think that you have higher spending on gasoline because gasoline prices go up. I think that clothing and attire spend, I think apparel really gets hit because if you're worried about where you're going to live, you're not going out and shopping. And you also have some inventory ruined because of that. So retail sales is a bit of a question mark. Auto sales, I think actually, on the one side, you're missing out on all the Labor Day sales in Houston area. On the positive side, you now have tons of damage. People are saying $100 billion of damage could be the result of this hurricane. And everyone who's just lost a car, they're cashing out insurance and they're going to buy a new vehicle, which gets to the insurance companies. There's a gut reaction to say that insurance companies really get hit on this because they're ultimately on the hook. But the way the insurance industry has developed is they have these reinsurance companies. So an insurance company will come and they'll insure for the normal, almost predictable events. They're not going to insure for the catastrophic events. For that, they'll get reinsurance. And so the reinsurance companies, those are the ones who are really going to get hit on this because the insurance companies like a Chubb, they're going to go to their reinsurance company and say, hey, we bought insurance for our insurance liability. So, it gets rehypothecated on top of itself, but ultimately I think the insurance companies will actually get through this okay.
Very good, very good. So moving on, this is Young Bucks. We talk about money. We find ways to make you money. Last week we gave good advice on the Mayweather-McGregor fight. We all picked Mayweather to win that fight, so hopefully you
went on a limb on that one.
Yeah, hopefully you put money on that. If so, you're richer this week than you were last week, at least in that particular portion of your portfolio. So we're going to keep that trend going in terms of making you guys money. Obviously, we don't encourage you being reckless with sports betting, but we are. So we're going to do this every week, college football picks. We'll try to keep it quick, but this week a little bit of an introduction. Ben is a Washington fan. Krebs is a Wisconsin fan. I'm a Georgia fan. Sam's a Bama fan. Every week we're going to pick those four teams' games against the spread. We're also going to pick 1/5 kind of national game of interest. So that game of interest this week is Florida-Michigan, two highly ranked teams. But starting off, Ben, Washington's a 27.5-point favorite against Rutgers. Talk to us and give us your pick.
I'm really excited about this game. They started off against Rutgers last year, and here are some quick stats. Jake Browning, who's actually in the running for Heisman discussion this year, he was 18 for 27, 3 touchdowns, 1 interception, 287 yards. His QBR was 97.2. Opposing quarterback was 24 for 40, no touchdowns, 1 interception, 168 yards, QBR of 15.5, so pretty bad. On the negative side for Washington, you've lost John Ross. I think they have enough pieces. They've got some great freshmen coming in. They're going to try a little more with the tight ends who didn't play a big part last year. You lose Azim Victor and Austin Joyner, who got busted on failing a drug test. So Coach Pete has kept him out for this game. Last year they were up 34-3 at halftime. It was at Husky Stadium. which is the loudest stadium in the country, 133.6 decibels recorded. And so I don't think they actually cover the spread this year. I think the spread is 27.5. I'm taking the under at that, even though I'm a Washington guy. I don't think they get it done. I think they have bigger fish to fry this year on their road to the national championship.
All right, Krebs, Rutgers or Washington? 27.5 point favorite for Washington.
I'm going under.
What does that mean?
What? Wait, what was the question?
Are you picking Washington minus 27.5?
Oh, Rutgers. I'm Rutgers.
Oh, sorry.
Sorry.
I'm going to go the other way. I'm going Washington. Sam?
Oh, man, this is tough. I'm going to go Washington.
All right, so a little split decision. Going to the next game, we're doing this basically based on time of kickoff. So, Sam, you're up. Bama, a 7-point favorite against Florida State.
Yeah.
Neutral site game at the Georgia Dome.
So
or whatever it's called now.
I definitely don't have all the stats that Ben does, but the thing that I go back to, and you hear this on TV all the time, and that is just Nick Saban preparing for a game for, essentially 9 months. And he's going to have them ready to play. And you think about it, I think back to when Alabama played Georgia in the Georgia Dome, what was that, Saban's first or second year?
2012.
Yeah, was it 2012? I don't know. It was a long time ago, but they've done this big game to start the season, and every single year it's supposed to be a huge game, a huge challenge to Alabama, even though they're the favorite, and they just come out and they just crush the other team. I think Florida State's a very good program. I think they're going to have a very good team, very good season this year. I just struggle to believe that Alabama just won't be more they will be more in midseason shape, at least for this game, than Florida State will. And so I give Alabama the benefit of the doubt. I think that last year playing USC, they didn't look great. They had quarterback issues, and I'm pretty sure they covered the spread opening the season last year. So I'm going to go with Alabama covering the spread.
I got Bama as well. Krebs?
I'm going to have to take FSU because Sam and I have a bet on it outside of this.
There you go. Ben?
Alabama.
All right. Next up, we got
That's some alpha there for me.
Wisconsin, 27.5 point favorite against Utah State. Another powerhouse game here. Krebs, talk to us.
I'm actually pretty uncertain on this one. Wisconsin lost their lead running back in Corey Clement last year. I think he was personally overrated, so I think there's a chance that they actually get better at that position, but until then it remains to be seen. I think they're going to start pretty slow. I feel like they have done that in the past. So
they usually finish pretty slow, too.
Yeah, that's not won their bowl game last year. So I guess short answer to that, I'm taking Utah State there. I'm actually surprised that their spreads are the same there with Rutgers and Washington. I think Utah State's a much better team than Rutgers is. Rutgers is always bad.
And betting on Wisconsin to score 4 touchdowns in a game is bold anytime. Ben, what you got?
I got Utah State.
Oh, man.
Sam? I've got Utah State as well.
Wisconsin.
All right, he's got Wisconsin. Georgia opening the game, 14.5 point favorite against App State. Everybody always wants to point to the App State-Michigan game, but App State's actually a viable FBS opponent. They're not from a Power 5 conference, but they've won 21 games over the last 2 years, won the bowl game in each of the last 2 years. So it's a decent game to at least start the year off with. I think that spread's too small, though. I think Georgia's got a lot to prove in terms of just establishing themselves as a team that actually wins games in a decided fashion when they're supposed to. And that's something that Georgia struggled with for several years. That's why Mark Richt was canned. Last year, I think, was kind of year 0 of a transition to Kirby Smart. So I think this is, as odd as it is, it's actually a chance for them to come out and say, no, Georgia's significantly better this team. They're favored to win the SEC East and therefore should beat an App State team by significantly more than 14 points. So I'm taking Georgia in this one. Sam, what you got?
I'm falling into the trap that the past predicts the future. I'm going with App State.
All right, Krebish.
I can't bring myself to bet against Jacob Eason, so I have to go Georgia.
Big Eason guy. Ben?
I got the Bulldogs.
All right. So last game, the game none of us have any attachment to. Michigan is a 4-point favorite against Florida. This is at AT&T Stadium. No preview here. I'll just jump in. I'm going with Michigan -4. Krebs?
Yeah, Michigan. I mean, Florida's still missing like their 5 really good guys, right? They're suspended.
And they haven't had a quarterback since Tebow.
Yeah,
so.
I got Michigan.
Ben?
Yeah, Michigan.
Michigan as well.
All right, so there we go. We'll get that up. We'll check our total next week, and then we'll make more bets as we go on. This is What the Buck. Y'all have a great day.
Hi, everybody. Welcome back to Young Bucks. Today we're in our education segment. We're going to be talking about the concept of a value trap. So value traps come up in the course of investing, especially in equities. This is when you buy a stock or look into a stock that you think is cheap based on its historical metrics. So, for example, it has a low price to earnings ratio, and we'll talk a little bit about that. But actually, the trends are so bad that this is a company that's almost in free fall. So it just keep getting cheaper and cheaper and cheaper until you have a day of reckoning where either they cut guidance massively or they just go totally belly up and go bankrupt. So what does it mean to have a stock that's cheap? If it has a low price to earnings ratio, that's something that a lot of people look at when they're looking at a cheap stock. Price to earnings is essentially the price you're buying the entire business versus what they've earned in a single year. So let's say you want to buy your kids' lemonade stand from them, and the lemonade stand makes $10 a year. You might want to buy it for $50, which would be a 5 price to earnings ratio. That would be a reasonably good price. Now, if your kid starts to get really ornery, they might want to sell it to you for $100, and that would be a 10 price to earnings ratio. So just getting into some examples, because I think that's the best way of describing to you what a value trap is. So the first example we have is a company by the name of Teva Pharmaceuticals. Now, Teva is a generics pharmaceutical producer, and what they had is they had 4 real key items that stood out in terms of showing that it was a value trap. The first was a bad situation. The second was what we call the quick fix. The third was the temptation, and the fourth was, quite frankly, the fall, both in the stock price and in the business in general. So the first, the bad situation, this was brought about by having a falling top line. Their revenue was declining because their pricing power in generics was getting gradually eroded as more generics came onto the market. The quick fix was an acquisition they did of an Allergan's generics unit. Now, Allergan had only just recently acquired this business, so Teva really didn't know what they were buying. And so they loaded up their company with debt to make this acquisition that was supposed to be the game changer and save the company and become the preeminent leader in generics. Well, that didn't turn out. The third is with temptation was the fact that it was cheap based on historical metrics. I mean, this is a company that made $5, $6 earning per share and was trading for $35, $40, which ostensibly is cheap when other pharmaceutical manufacturers are trading at 15 times earnings. So you're talking about half the valuation versus other pharmaceutical companies. And the last piece, of course, is the fall. This is the high debt level that they really incurred as a result of the acquisition that would try to be the quick fix saving of that initial problem, which was the falling top line. So that was Teva Pharmaceuticals. Stock price now currently trades at less than $20 a share. Second was GameStop. Now, again, they had a falling top line. GameStop obviously sells video games. They have a number of physical locations. They have also an online presence. And they were seeing that everyone's buying games online now. They also saw that people are refreshing game systems less often. Mobile has become a big story there. So that was a bad situation. Then they had this delusion, the second thing that we called the delusion, and that was they were ignoring and dismissing the macro trends, saying, it's not really our fault. Everyone's having this problem because no new game systems are being launched. That was the delusion. They kept thinking that something was a new Call of Duty would come out and save the quarter. That continued to not to happen. They continued to have to lower guidance as a result. The third was the shift. And this is the new product that was designed to save the day. So GameStop said, well, we can't make any money in our business currently, so we'll buy AT&T's retail outlets and operate those instead. Now, if you actually think through this, buying thing from AT&T should have synergies with those retail stores because they have a marketing presence and they're able to train their employees and repurpose their employees. So they should be able to operate those at larger margins inherently than a company like GameStop. GameStop doesn't think that way. They needed to solve their problem, which was the falling top line, so they start buying these AT&T stores, which really don't end up adding that much more margin and just exacerbate the falling top line situation as well as the cash position on the balance sheet. That's GameStop. The third value trap was JCPenney. And this one's probably the most widely known story. This had a falling top line. Again, they're seeing same-store sales decline 10, 20, 30% on a year-over-year basis. That was a bad situation. And then they had this Messiah CEO. Bill Ackman came in. He was a very activist investor. He brought in his handpicked guy, Ron Johnson, from Apple. So Ron Johnson ran the retail segment at Apple, which, of course, is a high-end store. Now they're coming to JCPenney's, which is a lower-end department store. So already you can start to see that this savior may not be the one they were looking for. And then you have the temptation again, the low valuation in this case based on what they had earned previously. So a lot of people were saying, okay, well, if you go back 5 years, JCPenney was making $3 a share and the stock trades at $10. That's really cheap. But they're making a loss now, but that's because they're in this transition and they have this new CEO who's doing all this great stuff. But at the same time, you have to think, what is actually going on behind the scenes? Is this the right thing that's happening? And then, of course, you have the high debt load at JCPenney's, which was really just very, very difficult to climb out of. And the stock has now fallen, continued to fall from $10. Now it's about $3 to $4. Finish Line is our last example here. This is most present in the minds of people because the stock was down 30% on Tuesday. Again, you have the falling top line, the bad situation. Got to watch out for this because management teams come in and they try to solve this bad situation, but sometimes when they try to solve it, they just make the problem worse. And the problem for Finish Line, the second issue here that we haven't seen an example of yet is this hopelessness, the idea of hopelessness, because they have a lack of pricing power. They can't stimulate demand. They're reliant on other people. They're reliant on Nike to, in their good grace to give them the best products, whether that's this new Foamposite, which is a new Nike product that's coming out, or whether it's giving them the new LeBron shoes, giving them good availability on that. But at the end of the day, Finish Line doesn't really control their inventory. They don't control what they get. They don't control too much about how they price their product. And so they just see margins continually crimped. And as the operating leases continue to rise and rents continue to rise 1%, 2%, 3% a year, you start to see those margins shrink in what is already a small margin business. So those are some characteristics of a value trap. There are many others, but the idea is look beyond the price to earnings ratio and say, is this price to earnings actually justified because the actual business is declining so rapidly? So be careful of that in the future in your investing. Thanks for joining us on Young Bucks.
Hey everybody, welcome back to Getting Tanked, where Ben and I stand in front of a fish tank and talk about important financial matters. I'm Andrew Hall. Today we've got a death panel. That's right, we're going to be talking about some stocks and some industries that are getting real pressure from the market, specifically from Amazon. So Ben, jumping right in, obviously Amazon putting pressure on retailers in general. Before we jump into some of these specific industries, how valid do you think those pressures are?
Well, Andrew, I think it's very valid. And the reason for that is because not only is Amazon taking a greater share of the retail budget, but it's taking a greater share at a faster pace. So if you look at retail spending and where it's being allocated to, e-commerce has taken a greater percentage of the prior year, but it's also that percentage is increasing at a faster rate.
So first industry we're going to talk about today facing pressure from Amazon is actually the shoe business. So kind of interesting to see a number of companies take some heat. Companies like Foot Locker, Finish Line, Hibbett Sports, Nike, even a company like Dick's really getting jerked around. But Ben, the one that stands out the most to me, Nike.
Well, it's a great point, and the concern about Nike is well taken. However, I mean, at the same time, we haven't received any data from Nike. All we've seen, and the reason Nike's stock has fallen so dramatically is really because of the concern that if Finish Line is missing and the stock is down 20, 30%, if Foot Locker is missing and their stock is down similarly, Hibbett and Dick's, and it just continues, the implication is that, oh, it must be bad for Nike. But at the same time, you've got a lot of Nike sales that are now going direct to consumer and they're disintermediating, which is a fancy word for meaning cutting out the middleman. They're getting rid of those middlemen who are just selling shoes that they don't really add any value other than just a place to go and buy the product.
Yeah, and it's been interesting. Even some of Nike's like premium releases, the limited releases that you used to have to, go to a Foot Locker or a Finish Line for. Now Nike has their sneakers app where you can actually get in there and you get notification on what's coming out. So it kind of makes sense. I don't think you can directly read through to some of these retailers. Do you see pressure letting up for the likes of Finish Line? I mean, I can't remember the last time I went into one of those stores, a Finish Line, a Foot Locker, a Hibbett, and actually made a purchase. So it's hard to see that turning around from my viewpoint, but that may just be from one consumer's perspective.
No, I think that's a general trend that's facing the industry. I think that there are still times when you need to go in and try on shoes. For example, if you are an athlete and you really want to get the shoe that fits the best. But if you want to get a shoe that looks good, then, I mean, you can just go online and see the same thing. The thing that I would caution on Nike is that I don't want to say that there hasn't been any pressure on them, because I think that they are losing some share to Adidas. However, I mean, people still need new shoes, and Nike is a prime vendor of that.
So moving on to kind of another, I guess the most comparable comparison, at least to the three industries we're looking at, we have department stores. So companies like Macy's, JCPenney's, which, I mean, honestly, JCPenney's has been under pressure probably longer than this looming threat of Amazon has been there. I mean, they've had all kinds of issues in terms of restructuring, things like that. Again, department store seems a little bit more viable to me. Maybe as a consumer, there have been a handful of times in recent history where I've gone in, maybe I'm looking for a shirt, I don't know what fit I want, things like that, and I'll actually go into one of these stores, check it out, maybe even buy it there. But how do they overcome the challenge of Amazon?
Yeah, it's a great question. And the reason that they might have an ability to is because they can be a one-stop shop. Having said that, mall traffic is clearly under pressure. It's getting killed. And the reason that a lot of these companies are staying afloat is because their lease operating costs are falling. The mall operators get that people go to Macy's and JCPenney's because they have a Macy's and JCPenney's. And if they didn't even have those, then these what we call anchor tenants, then people aren't even going to come to the mall even for those. So there is a little bit of cushion there. The key is, if you want to look at it in a department store, you have to watch the debt, and that's what's killed JCPenney's, is they've had so much debt. Macy's actually has assets, so I think they own a lot of property, especially Herald Square in Manhattan. That's a very valuable property. Having said that, I mean, you're looking at industry under pressure. People are still buying clothes online, and it seems like they're going to continue to do so in potentially greater numbers.
Last industry we're going to hit on today, and then we're going to kind of wrap this up with maybe a short ranking of these industries, but grocery stores. Interesting to see, obviously Amazon getting into the grocer market with Whole Foods acquisition. People have talked about that. They've announced recently the price cuts, things that are going to come to fruition, which I think most people are in favor of if they shop at Whole Foods and stores like that. But what's wild is just the pressure that is put on companies like Kroger, even Target to an extent, which does have a grocery business. From my perspective, the grocery business is under a little bit less pressure than, say, the shoe retail business or department stores. And I think a big part of that is just demographically. It's hard to picture someone like my mom. She's not going to order groceries online ever. She just got an email account a couple years ago. She's not ready to make that jump. So it seems like you're going to have at least a decent sized portion of the population that is still relying on physically going to a grocery store, walking through the aisles with that buggy, as inefficient as it may be, and making purchases. So it seems like there's a little bit less pressure there, but nonetheless, the market reacts to news like this.
No, the market does react, and Amazon, of course, buying Whole Foods has been the big catalyst. And the concern is not so much, in my opinion, that people are going to start buying from online vendors for groceries, which they are doing, but I mean, that's going to take a long time to get to critical mass, I think. I think the concern for them is that they start using grocery stores as a loss leader. So grocery stores not being designed to make money, instead grocery stores being another arm of marketing, another arm of distribution for an e-commerce website like an Amazon. And if that's the case, then they don't need the grocery store to make a profit, which makes it really tough when your whole business model is being in groceries. So I think that's where things become a little tricky. Again, just like the department stores, watch the debt, because a lot of debt is taken on under the assumption that you're going to continue to make cash flow. And if that cash flow starts to dry up, that's when you get into big trouble.
And that lost leadership is really something that seems like it could be a two-pronged impact. So looking at a company like Target, whose stores have, yes, groceries, but also clothing and a little bit of everything kind of in there. If they decide, hey, in order to remain viable and to get people in our stores, we got to slash grocery prices. And that means we're going to operate those at a loss. Well, that does two things. Number one, that impacts Target. But secondly, that has a pass-through impact on other grocers, because if I can go to Target and buy a gallon of milk for, let's call it $2, I don't really care if they make money off of that or not. If Kroger's going to cost me $2.50, presumably I would go buy my basket of goods, my milk, my eggs, my bread, everything that goes with it, my beer, from Target, and not really care about Target's margin because it's cheaper. So then all of a sudden Kroger says, well, hey, we want Andrew as a customer. We got to slash prices. And all of a sudden it starts to trickle down really quickly. So definitely something to keep an eye on. Ben, I don't want to power rank or go to too much detail here, but this is the death panel. We're talking about industries that a lot of people think may be dying, or at least going through a really, really ill period. Who is the closest to life support of these three industries?
I think there are some department stores, actually, because of that debt, that are really, really under pressure. However, if we're just talking in these three buckets, I would say the shoe stores, then the department stores, then the grocers.
I think I agree with those rankings, but again, kind of continue to look at this, as we've said before on Getting Tanked. Look at everything company by company. Not every trend that applies to one industry applies to another, nor does it necessarily apply to every single company within that industry universe. So keep an eye out on that. This is the Young Bucks Show. Y'all have a great day. Hey, everybody. Welcome to the Call Out. This is when we call out people that we disagree with in the business world. Today, we are calling out people who blame millennials, that's you guys, for the death of really crappy industries. That's right. A lot of people love to blame millennials for things declining. A lot of those things should be declining, though. Today, we looked at a list from Business Insider that blamed 19 specific things on millennials, industries that are fading or dying. What I did here was I went and made a category for all of these things. So the majority of these things are things that just suck. That's the vast majority. Casual dining chains, places like Applebee's. Guess what? Applebee's kind of sucks. I'm okay with my generation killing restaurants like Applebee's. Along with that, separate title is actually the restaurant. So your Hooters and Twin Peaks of the world. Apparently, we're not quite as interested in looking at cleavage and eating wings as maybe the generations before us. So again, kind of okay with that. Golf, yeah, it's pretty boring. Cereal, yogurt, things like that, not really a big fan of those things. They're pretty mundane, if you ask me. Banks, we're not physically going to banks. Why on earth would we physically go to a bank if we don't have to? So yeah, we are killing banks because we don't like wasting time on things like banks. We're spending less money on oil. We're buying less of that. Last time I checked, that was actually a good thing. Department stores, we're being blamed for Sears. I mean, Sears has gone through bankruptcy multiple times. That's not really our fault. So most of these things, they just suck. Other things that suck that millennials are being blamed for, gyms are on decline, fabric softener. Oh boy, that's really putting a dent in the economy. Other category we have are things that just have better alternatives. Interestingly enough, beer consumption is on decline among this generation. Kind of good with that. We're drinking a lot more good stuff. We're drinking more liquor. We're drinking more wine. Check out our asset allocation video if you want to know more about those things and how we view them. But that's on the decline. Napkins, yeah, we're giving those up because we like the paper towel. It's a little bit more versatile. Sue us. Bars of soap. Why would we use a bar of soap when I can have a bottle that has shampoo, conditioner, and soap inside of it? Again, I think that's a good thing for us to get rid of. Another category of things we're getting rid of, things that are really expensive. Designer handbags and diamonds, both on the decline. I don't think that's necessarily a bad thing for a group of young people. Lastly, we've got two categories. One is fake news. It is absolutely fake news that football is on decline. Watch our segment on What the Buck. We talked about football for most of this podcast. And then iffy. This is the one category where you could actually make an argument that millennials should be more engaged. It's home ownership, and tied to that, home improvement stores like Home Depot and Lowe's. Obviously, if you don't own a home, you're not spending a whole lot of money on home improvement, but you should probably start looking at building up some home equity. Start thinking about making that purchase as you save up some money and you find some opportunities. So that's the one area in which I'm kind of okay saying, you know what, millennials, get out there, get yourself some more homes, do it comfortably. You only need one. You only need one, and you only need to be able to afford it. You don't need anything more than that. But the rest of this stuff, you guys can kind of have it.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.